Well, I'm back after a 2 week break, back at it again, and the new format here. I'll be doing the Sunday market outlooks, but they'll be much shorter. They'll be condensed to within 30 minutes, hopefully 30 to 40 minutes, and then I'll add content throughout the week. So let's begin with our rates. Money market rates over the past week, well behaved. Capital market rates did notch an increase. And if we look at the cycle highs on our capital market rates last week, the 2 to the 30, all the tenors, all the key rates hit new cycle highs in their yields. And same with the money market rates, the 2 month hit a cycle high, the 4 months hit a cycle high, and the 1 year hit a cycle high. And this was in reaction to the Fed Summary of Economic Projections. 12 of the 19 saw or penciled in a one more rate increase this year, and probably more damaging for next year. Rather than penciling in 100 basis points of cuts or potential cuts, only 50 have been penciled in at this point. So you have a bear steepener going on the long end of the curve, and with a bear steepener you should get a steepening of the yield curve, which means less inverted. And we can see the 2 to the 10 became less inverted, and more importantly, the 3 month to the 10 year, the money market to capital market inversion is less inverted by 11 basis points. Thursday was an ugly day for capital markets, for the long end of the curve for capital market yields. A really ugly day, and some of that might have been due to the risk event in the yen later that evening, on Thursday evening after the US bond market closed. You had Japan's CPI and the BOJ, and there's a lot of thinking that by the end of this year the BOJ will move, will do something they haven't done for a couple of decades now. They're actually going to move, which would strengthen the yen because it would unwind the carry trade. You don't want a strengthening yen. The other thing that it would do is it would cause the US dollar value of Japanese citizens who hold US bonds, the US dollar value to drop against the yen if the yen strengthens. So even though you get a higher yield in the US and a lower yield in Japan, it relies heavily on a weaker yen and a stronger US dollar. Anything that would push the yen up would start a cascade effect that would really drive the value of the yen up. So there might have been some selling of treasuries in anticipation of the BOJ moving, because on Friday it did reverse that a little bit. Although I will say Thursday was a little much on the selling. I'll talk a little bit more about what I think could happen on the long end of the curve when we get to TLT. The Fed continues to run off its purchases during the quantitative easing period, down another 26 billion. That account, the SOMA account, is now sitting at 3.47 trillion, heading down to the $6 trillion mark. I don't know that we'll see 6 trillion by the end of the year, but it is heading there. The full balance sheet now just a smidge over 8 trillion, dropped about $75 billion week over week. The SOMA ran off 26 billion, so there was another net 48 billion that ran off the Fed's balance sheet. And money market funds, a decrease of 7 billion. Retail not playing along. Retail increased 7.3 billion on both government and prime funds. Institutional dropped by 14 billion. Government bonds dropped by 13. Government money markets dropped by 13.24. Prime by 956. I checked bond funds. The data for inflows and outflows on bond funds are a week behind, whereas this is a day behind. So we're not really going to know if money left the money market funds for the bond funds. In other words, moved from the money market to the capital market because of the higher yields. We're only going to know that next week, whether money flowed into bond markets or flowed into equity markets given the pullback that the markets had last week. Next FOMC meeting, November 1st. Well, it's October 31st and November 1st. Next FOMC decision date, let's say it precisely, is 38 days away, sitting at 73.7% probability of nothing happening. Last week was 72.3%. So zero expected for the next meeting. Hasn't really changed much. In fact, it went from 72 to 73, slightly more in favor of zero. 25 basis points is 26.3, down from 27.5 the week before. So maybe the market thinks that one extra rate hike will happen in December. 5.5% went from 60% down to 54%. Not a lot of conviction there, right? 5.75 went from 34 to 38%, and then a little bit at 6%, which I don't see as a possibility. So week over week, not a lot of conviction in suggesting 25 basis points. So that ugliness we saw in the capital markets must primarily be due to a lack of 4 rate cuts being penciled in next year and only 2 being penciled in next year. September minutes, 17 days away. We get in 4 days the final look for second quarter GDP. Usually there's not a lot of movement on the final look. And August PCE in 5 days, and we are adding in the clown show again. We had the clown show again with the debt ceiling. Now we have the clown show again with the government shutdown. With a slight difference here. They're both clown shows. Republicans are going to take every minute they can to get free campaigning on this because cameras will be on them because they pretty much will determine what's going to happen. Democrats just want it to happen. Hey, come on, sign here. Republicans are the ones that will decide whether or not they do sign there. So they're going to take all the free campaigning they can get. However, with the debt ceiling, I thought they're gonna come to a deal because the outcome would be far too negative. There was no winning with not coming to a deal. But here, the outcome is not that negative. It's negative for GDP, yes, but it's not that negative. It's a government shutdown. The printing press of paying simply just goes on hold for a while. So I thought the odds of not having a debt ceiling agreement were very low, but I think the odds of not having a budget agreement are very high, in which case come Sunday morning I think a lot of people will be staying at home, which brings up a question that was brought up in the press conference to Powell. What if you don't have data? Depending on how long the shutdown lasts. If it lasts like 5-6 days, they'll have data before they get to their November 1st meeting. But what happens if they don't have the data, because the very next Friday is the jobs report? Well, government shutdown, that's not going to happen. Getting into the middle of the month, you're going to get CPI. Government shutdown, that's not going to happen. So what if the shutdown does last long enough and they get into November with absolutely no data? I think they would go zero because it is only a negative for GDP. You also have UAW. And some other unions. You also have what's going on in California with the unions there. That's negative for GDP. So in the lack of data, just with the idea that nobody's getting a paycheck that should have been getting a paycheck, that's going to take away from consumer spending, and that will be positive for inflation, negative for GDP growth. So I think they'd go with zero. So a government shutdown may actually increase the odds of nothing happening. Monday, this is the calendar I have so far. Usually it increases throughout the week, but this is who we have speaking this week. Monday, Kashkari. Tuesday, Bowman. Thursday, Gouldsby, who will probably calm the market down because that's his stance. You have Cook and you have Powell. Friday, you have Williams. Williams will probably calm the market down as well because he is thinking that as inflation drops, you're going to have rate cuts just to keep the real rate from getting way too restrictive. And we'll see how restrictive real rates are right now. Well, on the next screen, we'll see how restrictive real rates are. Effective federal funds rate sitting at 5.33%, unchanged. So if we look at our lags, 3-month lag, 6-month lag, 9-month lag, this is where the effective federal funds rate was that many months ago. This is where it is today. So here's the difference between them. 3 months ago it was 507, it's 533. So there's 26 basis points difference. So if you think, well, these things work with a lag, pick your lag. If you think, well, it works with a 12-month lag, that means there's 300 basis points of hiking that still has yet to be felt in the economy. So everything we're seeing is the result of 225 basis points of hiking, because we did lift off from 8 basis points. Still 300 to be felt. Look at the reverse repo, under 1.5 trillion now. Ended at 1.42 trillion, an increase of 26 billion week over week. But remember, it was over 2 trillion for a very, very long time because there just simply weren't enough Treasury securities around to sit in. Well, now there are. So as the Treasury is issuing securities in the market, the use of the reverse repo, which had to pay interest on that. It wasn't the Treasury paying interest, it was the Fed paying interest, but in the end, the Fed returns all that money to the Treasury anyway, so using the transitive property, the Treasury was paying that interest anyways, and it's down now some 800 billion, because it was sitting at 2.2 trillion for quite some time, down some 800 billion. So those T-bills issued into the market are being absorbed. Okay, let's begin with real yields. All key rates from the 5 to the 30 hit new cycle highs last week on Thursday, on September 21st, and finished all of them above 2. And you still have an inversion from the 5 to the 10 of 21 basis points. Not much change on the break-even rates, the difference between the nominal and the real yields. Let's look at Fed Fund futures. Lots of excitement here. The curve bottoms out, the index I should say, well, that's the curve of the index, bottoms out in February. Used to be November, now it's all the way to February. Implied rate of 5.465. Going to mid-year, which is June, 94.72, 5.28, implying maybe there's one rate cut in the first half of next year. 2 rate cuts are penciled in. It looks like the market is still leaving room for 1 rate cut. Let's look at the real federal funds rate. We have real rates for the 5 all the way to the 30, but let's look at the effective federal funds rate, the real funds rate. And for that, we'll start down here. I'll just draw a square around it so that your eyes are drawn to what I'm pointing at here. The long-term federal funds rate, the target, this is from the Summary of Economic Projections, the SEP. They pencil in at 2.5. That's a nominal rate. And we assume that they must be targeting the neutral rate, 2.5%. Their PCE target is 2%. So that means their real FFF target must be 50 basis points. We can imply that they feel that that is the real neutral rate. The nominal neutral rate they have at 2.5 because it is their longer term target. Why would they pick anything but the 2.5? They'd want to get to neutral, which implies 50 basis points being neutral. So anything above 50 basis points would be considered restrictive territory, and we'll figure out if they're in enough restrictive territory here. So let's go to the top of the screen. The current effective federal funds rate is 5.33%. Let's try to get to a real rate, and we know they use PCE. So we have an actual number for July, 3.3. We haven't got the August PCE yet. We get that in 5 days, but the forecast is for 3.5. So we can say, well, if we're going to base it on July, 3.3, this is year over year, we have a real effective federal funds rate of 2.03%. If we think it's going to tick up when we get the report in 5 days, if we think, yeah, it'll come in as forecast 3.5, you have a real effective federal funds rate of 1.83%, given that the The forecast here is 50 basis points, thinking that once we solve all of this, the real neutral target rate would be 50 basis points. I think you can say you are in restrictive enough territory at this point in time. 2024, let's go to year-end 2024, and this is all based on the summary of economic projections. If we look at their target for the federal funds rate, you look at the target and you subtract what they say PCE will be at the end of 2024, based on their projections, they're projecting a real neutral rate of 2.5%, because I think they're at 5.1% on the target rate, and being at 2.6% on PCE at that time would imply the real effective or the real federal funds target rate to be 2.5%, which is higher than where we are here. By 2025 year end, it's 1.6%. By 2026 year end, it's 0.9%, but their long term is 0.5%. So they're not going to get there, at least they think, till 2027, which sort of suggests extremely persistent inflation. Now, the question that we would have to ask is, can the U.S., with the current level of debt and the, I'm not going to say short-term nature, but shorter-term nature, being, I think it's like 5.5 or 6 years, it's usually that period of time that the debt rolls over, that you can consider all of the debt having rolled over, just based on averages, the average maturity of it all. Can we wait that long with elevated interest rates and still have a healthy economy going forward, given the low population growth of the U.S.? Or do we need to accelerate this process? In other words, how do we get rid of inflation like really fast, so that we can get rid of the interest expense, this very high interest expense, really fast? Because can we make it to 2027 with these elevated rates, with the real yield, not the real yield, but the real federal funds rate being elevated above 50 basis points, even by the end of 2026. Seen in that light, the Fed may be comfortable in actually causing a recession to happen. It would get it out of the way faster. You wouldn't have this long tail of inflation that they seem to be forecasting. It would get it out of the way faster. It might cause some pain now, but you can have some short-term pain, or you can have some very long-term pain with higher interest expense. Now, understand, every single penny a government spends has got to come from you. It's got to come from you. You're gonna pay for it anyways. So do you want a situation where everybody's got to pay for that higher debt, or do you want a situation where maybe 3% of the workforce lose their jobs? Those seem like better odds for you, right? TLT down 1.65% last week, and that pretty much came, the whole amount was delivered pretty much Thursday morning. SPY even worse, down almost 3% week over week. Volatility coming back in, really coming back in SPY. We'll look at IVP for SPY, and it's there. But for TLT, last 13 weeks sitting above 50%. The last 52 weeks, 17%, which is rather low considering over the last year. I sold some of my TLT last Thursday. I did realize a loss on that, but I bought the 25-year 3% coupon bond maturing in August of 2048 at a 4.73% yield, which is a higher yield than TLT is paying, because of course you have management fees and you have a constant duration or a duration window that is maintained. So what is going on here, just so that you can understand what's happening, is I am not really taking a loss. I'm just engineering a realized loss for tax purposes, because I'm in basically the same exposure. I'm not going to say the same security because I'm not in the same security. If I was in the same security, that wouldn't be considered a sale for tax purposes. That would be disallowed. But I am in a completely different security with the same exposure. TLT's average maturity is about 25 years of the holdings that they have, giving it a duration around 17 and a half. I got the same thing. I got the same thing with a higher yield. So I am in a different security with the same exposure and with a better yield on it. So it benefits me to have these realized losses, and then the unrealized loss is now sitting within the bond itself. So while I bought at 4.73, given the realized loss that I had, I probably have a break-even yield somewhere around 4.4, 4.45. So it's not as if from 4.73 down to 4.5 I'm making money on this one. I'm basically recovering the realized loss that I had over here. But going into the end of the year, if I can move my loss, my unrealized loss in TLT into a realized loss at my tax rate, it is an instant return. So that's beautiful. December 23, 1 month SOFR is sitting at 5.44. December 24, it's down to 4.6, implying 84 basis point drop over next year. That was, at one point, that was over 150, implying 6 rate cuts next year. Now we're implying 3 rate cuts, or 1 month SOFR is implying 3 rate cuts next year, while the Summary of Economic Projections has 2 penciled in. So it is, it's coming out of the market. The higher for longer is being felt, and I think this probably has some flattening to do on this curve. Now, let me say something about what's going on here. If we go back to 2008, early March, Bear Stearns failed. JP Morgan bought them for, I think it was $2 a share. The market clutched its pearls and gasped for a couple of days, and then went on to print new highs. Went on and put new highs, new all-time highs in the market after that. New all-time highs, pushing up to 1560. Then it started to give that up until about mid-September when Lehman failed, and then that was the end of it, and off it went. Now, I want you to, if you have time, I want you to go and look at the economic data at that time. The Fed funds rate was sitting at 5.25% that whole summer. The economic data was strong leading into Lehman. Initial jobless claims were not showing much of an uptick. They were way below trend. They were very low. Consumer was strong, even with gas prices hitting $4 a gallon, which back then was unbelievable. $4 a gallon. Oil was $120, $130 a barrel. The U.S. dollar was weak. The Canadian dollar was worth more than the U.S. dollar. So you couldn't get today. You take a U.S. dollar, you can get $1.35 Canadian. You were getting like 95 cents Canadian. Back then. Inflation was there. Inflation was running over 4% at that time, and the economic data was strong. What broke the economy was the subprime mortgage crisis, and Lehman being a victim of that, and that's what brought it down. But up to the moment that Lehman failed, you didn't see the end in the economic data. It was an event that caused everything to fall apart. An event. Because those higher and higher rates broke things. So, if rates had not increased, here's what would have happened. All of those teaser mortgage rates that people had at these low rates that would reset at market rates a year later, well, those market rates would have been lower. Many of them probably could have continued on. With those rates, and housing prices may have continued to trend upwards, which means they could have either sold their house and realized a quick capital gain, or refinanced with a greater equity cushion. It was the higher rates that caused the structure of all those mortgages, because you had so many short-term mortgages in there with rates that would reset, or interest-only rates that only lasted a year or 2 years, and that's it. It was the short-term nature of that, combined with the fact that a lot of people probably shouldn't have had those mortgages to begin with. That caused the problem. The U.S. doesn't have that today, but Canada does. The U.K. does. We have these short-term mortgages. At the max, we have 5-year mortgages in Canada, where you got to go back to the bank and you got to plead and beg for your mortgage again, and people are going back to the bank every single day and asking for that to happen. Canada is a much worse situation when it comes to housing than the U.S. is, because of that fixed rate mortgage. So I don't know that looking at the economic data coming out saying, aha, there's the clue, there it is right there, this is the beginning of the end, I don't know that that's going to work. It is going to be an event. Now, when Bear Stearns failed, the market went on and printed new highs until Lehman failed, and then that was the end of it. We had Silicon Valley Bank and Signature Bank fail, and the market went on and rallied past that. It sold off on that news for a little bit and then said, well, what do we care? And then off it went, same as it did with Bear Stearns. And that happened early March. Bear Stearns happened early March. Lehman happened mid-September. Signature Bank and SVB happened mid-March. And here we are in September. Almost uncanny. Nothing has happened yet, but here we are in September. What it's going to be, more likely than not, is some sector falling apart or some event happening that we are not projecting, that we're not even thinking about, or that there's some talk about, but nobody really sees it expanding. In the summer of 2008, and I'm not kidding you on this, you can go back and look at the record. In the summer of 2008, this was after Bear Stearns, and just a couple months before Lehman Brothers, Bernanke was testifying on Capitol Hill. And when he talked about the subprime mortgage crisis, he says, we see it mostly contained to that market with no spillover effect at all. The Fed has a horrible track record of forecasting the real world, a horrible track record of getting it done. So whenever we look at the summary of economic projections, it's like, okay, well, this is your fantasy team now. What's it in 2 months? You're going to have a different fantasy team, and it is just fantasy. It is just their best guess, but they lack, I think, a lot of experience in the trenches. Some of them come with experience, but they're not in the trenches every day. So I don't know that we should really think about the Fed as having the best projections out there, when after Bear Stearns and 2 months before Lehman Brothers, Bernanke, who is the foremost expert on the Great Depression, says we don't see any kind of spillover effect going from the subprime mortgage crisis. We see it mostly contained in that sector. I don't know that you could have been more wrong globally, not just in the US, but globally. I don't know that you could have been more wrong than that statement, given that the one person that would have had the insight into it should have known, or at least should have suspected, or at least should have said there is this possibility and did something before it happened, but nothing happened. No rate cuts. No liquidity lines opened up, nothing at all, no planning ahead of it to say, well, there is a possibility. It completely blindsided them. And it's going to be something like that. So the economic data is going to be good until something happens, then it's going to get bad very quickly. But it's not just going to deteriorate on its own and cause something to happen. I don't see something happening just from the weight of everyone going, oh, I'm really tired of all this today. Like every day we come in here, we try to sell, we try to control. Let's just give up for a while. Let's just shut it down. It's just not going to happen. It's going to be some external event. Okay, let's start with OAS, corporate spreads. Unimpressed with everything last week. Look at this, almost nothing going on, really. Just moves this way, moves that way, no moves at all. Corporate spreads just seem unconcerned about everything here. That is why we only have one little chart on it, and I spend 30 seconds each week on it saying they don't really care. So let's move on. We don't care if they don't care. 30-year fixed rate mortgage, 7.19. This is as of Thursday, 7.19%, over 7%. And let's just look at the NAHB index here, because at the beginning of the year, this was the story. It was how strong housing is. It was on a tear. And even earlier in the year, I had showed you some returns for some of the housing stocks, up 50, 60, 70% year to date. You would think that you were dealing with tech stocks. No, you were dealing with housing. The home builders were on fire. Well, this is the story now, how quickly they're deteriorating, and they are deteriorating quickly. NAHB Housing Market Index for September came in at 45. The month before it was 50. The month before was 56. So you had to drop from 56 to 55, from 50 to 45. It is dropping fast. And this week we get new home sales. That's going to be an interesting number. Based on how fast sentiment here has been dropping, you have a sector, this is the diffusion index, anything under 50 is in contraction. You have a sector that went from expansion to being flat to now in contraction in a period of 2 months, 56 down to 45. Is it going to show up here in new home sales on Tuesday? That will be interesting to see. Markets had an ugly week last week, so none of these numbers here should be a surprise. Here's home builders. Here's the home builder ETFs. This will be, I think this will be rather interesting in terms of what prospects it holds for the home builders. But this deterioration is fast. Building permits for August were up 6.9%. Housing starts down 11.3% in August. This was the August number, 50. So 56 down to 50. You see it show up in housing starts. Mortgage apps up 5.4% for the ending September 15th. Existing home sales down 0.7%. And it's just, there is a lack of supply of existing home sales. There is an interesting report that was put out. I think it came out last week from UBS Global Real Estate Bubble Index. And we're going to just look at the first page. I have a longer video coming out about this, but let's just look at the first page of this report. So here we are, September 2023, the UBS Global Real Estate Bubble Index. It comes out every year. Let's just head down to the first page. So they give a number of cities here. They looked at a number of cities. The red, or the wine-colored one, bubble risk, Zurich and Tokyo. That is down a lot from last year. Last year there were 6 or 7 of them that were in bubble risk. Overvalued, a score from 0.5 to 1.5, and fair valued is negative 0.5 to 0.5. San Francisco, New York, Boston, fair valued. Sao Paulo, what is overvalued? Toronto and Vancouver. I would have thought Toronto would be closer to bubble territory, but last year they were. Toronto's simply now overvalued. Vancouver, overvalued. I'm going to talk a little bit about Dubai and Singapore here, and Miami, because I think they're important. Fewer cities at bubble risk. Tight financing conditions. Financial affordability of housing has collapsed as mortgage rates have roughly tripled since 2021 in most markets. Therefore, household leverage has been declining in most countries in recent quarters. You may read that and say, oh, well, wait, that doesn't make any sense. If you have tighter financial conditions and higher unaffordability, how can leverage be decreasing? It's because you're not taking on a mortgage. If you're not taking on a mortgage, you're not spending money on higher debt levels. You're paying down your current debt levels. You're deleveraging. You have a bunch of people with houses with locked-in mortgages, 30-year fixed-rate mortgages, who are saying, well, I'm not moving at this point, where normally they would. They would upgrade to a bigger house somewhere. They'd sell their house and upgrade to a bigger house and have a larger mortgage. In other words, higher leverage. Well, if they're staying put, they're not taking on a bigger mortgage, they're paying down their existing mortgage, they're actually deleveraging. So this is actually improving the balance sheets of households by saying, you cannot have this debt. Okay, well, I guess I'll just stay where I am, and their situation is actually just getting better. Household leverage has been declining in most countries in recent quarters. Could that be an explanation to the strength of the consumer in the U.S.? Because they do have healthier balance sheets, because they are, by lack of market opportunity, deleveraging. Inflation is a game changer. Inflation made a decisive contribution to the reduction in imbalances. While rising interest rates put pressure on house prices, inflation supports income and rental growth. So let's go back to tight financial conditions, this statement about leverage declining. You're locked into a 30-year mortgage. You decide that, well, I'm simply not going to get out of my 3% mortgage for a 7% mortgage, so you stay put and you continue paying down your principal. So you're deleveraging, but your income is going up as well. So your debt to income ratio is really dropping, thereby giving you an even healthier balance sheet. So that is what this is talking about. Inflation has reduced some of those imbalances and brought a bunch of bubble cities that were in bubble territory just into overvalued territory because of inflation. There is more downside in real house prices. However, a housing shortage has set the stage for a renewed boom in many cities if interest rates fall. I agree with that. Defying gravity, the most sought-after destinations in recent years are Singapore, Dubai, and Miami. Now, I've looked at Singapore, I've looked at Dubai, because they are tax havens, territorial tax systems where my income is not taxed in those regions. And Miami, let's say that I live in the U.S. and I simply cannot leave the U.S. because I have to be in the U.S. Well, I don't have to be in California in a high tax state. I can be in Florida in a low tax state. See that? I was not surprised to see these on the list of places with rising home prices or better housing markets, simply because the level of taxation today, along with the forecast for the level of taxation, because you got to pay all this interest on all this debt, and who do you think? In Canada, we have liberal and socialist coalition government. In the U.S., you have a democratic government. Who do you think they're going to go after? The middle class? The working people? No, they're going to go after successful people. You know they're going after capital. Not labor, but they're going to go after capital. So capital is leaving. Capital is going to low tax regions. Look at this. Prices are up as much as 40% and rents 50% higher than 2 years ago. In those hotspots of international demand, rental and for sale price growth clearly stand out. I can tell you I saw that in Dubai. I started looking at property because I know that I'm leaving Canada. I know I'm going to a territorial tax system. I chose Costa Rica. But when I started looking, Dubai was the one that came up first. I got the idea from a story about Panama, and I thought, oh, that's great. Let's look at the territorial tax systems around the world. I saw Dubai. I went there, looked at the property price. I go, oh, this is pretty good. But then a couple months later, you go back, you start looking. There are fewer properties available, and they're higher priced. To the point now that I look at them, I go, yeah, but that's fairly valued. I mean, that's what I would pay here. I don't want to pay what I would pay here. I want to steal a house. I want an incredible deal. In just the short period of time that I was looking at properties there, here's what I noticed. A lot of properties disappeared, prices went up, and there's a ton of properties that you look at on Realtor.com on Dubai that are late 2024, early 2025, late 2024. They're all model pictures of model houses that don't even exist. So there is demand going on. Most of the ones that I looked at are gone. Apartment rents have gone up and housing prices have gone up in the short period of time that I was looking at it. So I know I'm not the only person with capital that's looking to get the hell out of Dodge before our liberal governments dramatically raise tax rates to pay for all of this profligate spending. And then it goes on to talk about a bunch of other things. I'll be doing a video on this. There's Miami. Here is Dubai, still in fairly valued territory. There's Singapore at 0.47. I was going to see if this data set they had Costa Rica, but it was only 25 cities that they had done. Here's Toronto, 1.21. You can see the arrow. The arrow is pointing down, meaning that it has come down from bubble territory. But it is an interesting read, and I go through quite a bit of it. So there'll be a separate video up on this. But I thought if you wanted to get a jump on it, just Google UBS Global Real Estate Bubble Index, and you will get this PDF. Okay, let's look at the major index. S&P 500 forward 4-quarter operating earnings, and this is taking Q3 and Q4 of 23 and Q1 and Q2 of 22. IBES has it at 232.63, S&P Global at 230.28, given the closing SPX at 43.20.06. Here's your forward multiples. If you blend the two, we're at 18.66. This is the average of the two, 18.66 times forward earnings. This is our AI rally. We can see in here, this was in around this period of time, was NVIDIA's earnings report, and then you just had this rally. I had been short, thinking that we seem to have a fairly tight level of resistance right here, and I covered my short here. Many of you will remember that, only to have the market say ha ha and retreat a bit. It would not have totally recovered my loss, but I covered at the worst possible time. We did have a rally after that, and I did sell some calls at 4600 and 4650. 46 and 40. This should be a 50. 4650. I did cover that on Thursday. I closed my calls on that, so I was able to recover. I think it was 34 or 38,000 of the loss I had over here. But still, that was a losing position for me, being short beta. Looking for another opportunity to get that done. Maybe we will have a Christmas rally, a fourth quarter rally. I don't know that earnings starting in October are going to disappoint. I think companies have a lot of room with accounting policies to make the numbers that they need to make. So I don't know that that's going to disappoint. So hopefully we can get a rally, because I would sell some more calls again. I would introduce a short position. My only regret here is I didn't go in heavier. But I didn't go in heavier because I got so murdered over here. Once bitten, twice shy, right? You only want to dip your toe in the water. You don't want to stick your whole foot in. So next time I think I might go a little bit heavier, but still the memory of this, Let's look at IVP. Look at that, 13-week, 98%. That means that you got some premiums in the options. 79% on 26-week, 39% on 52. Some room over there to go. 50-day moving average is 446. 200-day moving average is 418. Sitting at 430 on SPY. We're sitting right kind of in the middle, 16 points below the 50 and 12 points above the 200. You're sort of in the middle on that. We have an upward trend line that we can draw. It has shown support at these levels here. That's at 425, which is 50 points down on the index, or 5 points down on SPY, sitting at 425. If you break through that, your next support would be the 200. And above your 50-day, since we're below, the 50-day will now act as resistance, 446. The downward trend line, which is just a new trend line that's appeared recently, is 449. It's not as long-term as this one, right? Because the peak was over here. So you're looking at, what, a 3-month, July to August is a 2.5-month trend line there. So it's not a strong trend line. This is a fairly strong trend line, 449. So we're sort of somewhere right in the middle of the 50 of the moving averages, and somewhere right in the middle here of the trend lines, closer to the bottom, 5 points from the bottom, 19 points from the top. That I think if you are thinking of selling puts on the index, or even maybe thinking that this might be an entry point, I would probably see if the trend line holds, if 425 holds, and if you have a sell-off to 425 and you feel like selling puts, that might be a good place to sell puts. If it gets to 425 on SPY, you might want to sell puts at the 200-day moving average, which is around 418. So at 425, selling 418 puts. If the trend line holds, you'll be okay. If not, then you do have at least some buying that may come in at the 200-day moving average. Looking at an expectation of the next 12 months, if we break it down into an income, an earnings growth, and a repricing component, our income component you pretty much are going to get, right? Your dividend yield and the change in shares. Yes, we do have a lot of IPOs going on, but these are not IPOing into the S&P 500. Right? It is more shares being available in the U.S. market as a whole, but not in the S&P 500 component. You don't IPO into the S&P 500. So as far as the S&P 500, the percentage change in the share count will be negative because of buybacks. So roughly about 3% return on the income component. Earnings growth, that is the percentage change in earnings. Right now it's forecast to be slightly negative over the next 12 months. Slightly negative. That's the wild card. I mean, because it's a random variable with a fairly wide standard deviation. So you could have as much as 10% to 11% earnings growth down to 10 to 11% earnings decline. It's a wide band. So there's a lot of uncertainty there. And then you have your repricing, which is the percentage change in the PE. What makes the job a little bit easier is these are positively correlated. If you have a strong earnings growth, you will get multiple expansion. If you have earnings contraction, I would say you should, I'm not going to say the would on this one, you should get multiple expansion. It would be odd to see earnings contraction, multiple expansion, but welcome to 2023. Which is exactly what we've had. Year over year, you've had negative earnings growth, but multiple expansion. So I don't know. Usually they are positively correlated. I know that if you got earnings growth, you would get multiple expansion, but maybe if you get earnings contraction, you'd still get multiple expansion. It's just a crazy market. It's a very weird market. So I got a big question mark there because I don't know what to pencil in, but I would say if you are expecting negative earnings growth, I don't know that I would be putting multiple expansion in as the savior. Although it has been, I don't know that I would do that. So if you think that while earnings growth might be negative 6%, at the most aggressive, I'd say the repricing would be 0%. And with a 3% income component, you still have an expected return of negative 3% on the S&P, which really isn't that much downside, being 3%. Not until something breaks. And when something breaks, this is where you get the multiple contraction very quickly without much going on over here. You don't have to have a big drop in earnings to get a drop in the market, because the drop in the market will come from the repricing. It will reprice downwards very, very quickly, implying that every dollar of earnings has a hell of a lot more risk. That the dollars of earnings can stay constant, but the perceived risk of each dollar of earnings increases. That's where you would get your major change from your repricing. So if something breaks, this is what's going to take it down. The percentage change in PE. Until you start getting earnings coming in, and when the market starts to see that earnings growth hasn't deteriorated that badly, your PE multiple will drop and it will start to increase. So the PE tends to lead. And since the PE has expanded this year, the thinking is, well, earnings will follow because the PE leads earnings. And we get that in October. And again, I don't think that earnings coming in are going to be the thing that takes the market down. It is going to be a Lehman moment. It is going to be a sector. If you go back to 2000, it was the dot-com bubble that burst. It's going to be something like that. Is it going to be commercial real estate that really does a number? Is it going to be real estate in general that really does a number? I don't know. Again, going back to 2008, Bernanke felt that the subprime mortgage crisis was well contained. And if you didn't have experience in that sector, you had to listen to the experts. You said, well, I mean, if that guy thinks it's contained, maybe it's contained. I don't know. Is commercial real estate going to have a bigger spillover effect? Well, what have Fed officials been saying? We think it is mostly contained to certain banks that have real estate exposure. Well, that's what Bernanke said in 2008 about the subprime crisis. Thing is, you don't know till you know when it happens how many threads emanate from that event to then topple the next thing that happens. We will have to see. Anyways, that will do it for this week.